So joining us now to discuss all of the various expectations, as there definitely are a plethora of them, I'd like to welcome in Angelo Zino, the Senior Equity Analyst of CFRA Research. So Angelo, thank you so much for being here today. We're so glad to have you ahead of this report here. And I know there was this complete tone shift several months ago where many were like, all of a sudden pessimistic. It felt like for not really a concrete reason, I'm sure, in light of the various economic situation that was in turmoil. But now, as we go into this report, I mean, you're still a tried and true optimist. So walk us through your expectations here for Nvidia, as this will be a hugely important event to the overall market.
Yeah, so thanks for having me. And, I mean, we remain bullish on the shares here. And, clearly there's been a turn of events here over the last couple of weeks, and rightfully so in many respects. But you had this run up going into the print here. Our expectation is all eyes are going to be on the revenue and the guidance, clearly driven by that data center business, which is now being driven by Blackwell. And you look at the revenue numbers, you're looking probably about 43 billion here for the April quarter, about 46 billion here for the July quarter. Implies top line growth to continue to be north of 50% on a year-over-year basis, but the sequential growth is starting to slow. So you're looking about sequential growth here of about 10% here for the April quarter, slowing to about 6% to the July quarter. A big reason for that, obviously, is some of the uncertainty tied to China right now. That's going to be a headwind, especially in the July quarter. And but that said, all else looks pretty good when you look at where the hyperscaler spending is, when you look at the Blackwell ramp and the potential margin expansion going into the second half. So overall, we expect it to be, an upbeat call, but there are still lingering uncertainties that we need to deal with here over the next couple of months and quarters.
Angelo, as we look ahead to this event, I think we're also still remembering those first few earnings quarters where they would hike the guidance by 20% and the market would get really excited and these giant moves would happen. But the reality is the last 3 quarters, not only has it either been down or unchanged right after the event, but it's actually been down 1 month after the earnings event. So it's no longer a layup for investors to be long into these earnings. Have we gotten the, overcrowded, over-optimistic, kind of one-sided, bullishness into these events? Has that kind of been washed out yet? Or is this still just risk for NVIDIA investors as we go into these events?
Well, I think that's a great question. And I think overall, when you kind of look at how the stock has reacted here over the last year, I mean, it really kind of lost its momentum around early summer last year, the way most of tech has, right? And it's kind of been range bound in many respects since. We've seen some significant multiple compression here over the last year. I think that's really kind of taken a lot of the luster out of the stock. The multiples now really kind of mid-20s on our calendar 26 estimate, typically where the multiple would trough out for this company in prior cycles. And when you actually kind of look at really, even with this nice run we've seen here off the April lows. So I think a lot of kind of, the expectations for this big beat and raise for the stock to go higher is really no longer, in these numbers anymore. At least that's not the expectation for investors. If anything, I think this is one of those situations where if the company can kind of report in line and actually guide in line to slightly above expectations, you're actually going to see upside in the shares. And if they actually, point to a slight miss, I'd actually think any type of negative reaction to the shares probably gets bought up, knowing the earnings potential that we think that we see ahead into the second half of the year and into next year.
Yeah, and I do feel like this sentiment into this print does feel different than in past times. Like we've all said, I mean, you needed in previous times a pretty significant beat and raise, but different expectations for this report and different Nvidia than we knew just a year ago. So I mean, as far as their corporate strategy, for example, I do think is interesting the way they've been more robotics forward as of late. And what enthuses you still within that strategy that perhaps the street isn't necessarily pricing in or expecting right now?
Yeah, I mean, listen, I think when we look at really what some of the negative sentiment that we saw earlier this year actually tied to DeepSeek on the belief that there were going to be greater efficiencies out there and potentially we wouldn't need as much compute. actually led to the opposite. And Jensen actually really articulated the story here very well here over the last couple of months. And when you've actually seen some of these, next gen reasoning models come out, you look at, the likes of just Alphabet last week with their Google I/O conference, and you look at the need for kind of, just an immense amount of compute from these next generation AI agents, and eventually, that's going to the baton's going to be passed to the physical AI world here over the next 2 to 3 years as that momentum ramps. I think you're still really early days as far as the need for compute is concerned, and that really bodes well here for Nvidia. And I think what's really great for Nvidia is there's this talk out there, whether it be tied to custom silicon or competing offerings. And there's legitimate need for those type of offerings out there. But what Nvidia really also does address is the revenue side of things. They've got more than 5 million developers across their ecosystem, and these SaaS-oriented providers need Nvidia's software as well as that hardware. So we think there's a lot of upside left from that physical AI as well as agentic AI.
Angelo, is it too early for shareholder-friendly discussions? I mean, this is a stock that investors of the last few years hadn't had a lot of downside, and as you said, it's been sort of sideways to lower. Do we expect maybe some of this immense free cash flow to get diverted away from R&D and maybe go to share repurchases or even a dividend?
So I don't think it's going to divert away from R&D, but what I will say is when you look at the revenue growth of this company, right, and the earnings potential, which is obviously going to lead to greater free cash flow, I mean, I think you're going to see more and more cash return to shareholders. They announced a $50 billion buyback last August. I think the prior year it was $20 billion. We're actually expecting something along the lines of a $70 to $80 billion buyback later this year to get announced. And this is a company, similar to Apple, very asset-light business model, right? So, unlike a lot of the other kind of a lot of the hyperscalers out there, mega cap tech companies that actually need to spend aggressively on AI, these guys are the big beneficiaries of that, and they're going to continue to generate higher revenue and free cash flow, and they're going to return more of that, to shareholders. So that is potentially a catalyst, especially as the top line does start to eventually slow down because of the law numbers out there.
Yeah, definitely not having too shabby of a month or too shabby of a session to start off this week. We're up 3%, but as we know, earnings can change everything. So we'll be watching those numbers closely as they report. We so appreciate that insight ahead of that print. Angelo Zino, Senior Equity Analyst of CFRA Research.